Thanks, Chad. Thanks, everyone. Delighted to see such a great showing. We have a truly unique and noteworthy topic to cover today. And I think no exaggeration in saying we have the best possible panel in the world to cover this topic. We're going to dive into the success story of Yammer. As you all know, Yammer is the leading enterprise social network. It actually started in 2008, debuted at what was then called TechCrunch 50 in September of '08, winning first place at that event. And then in the next 3.5 years, it raised $140 million in 5 separate venture capital rounds, and then sold last summer to Microsoft for not too shabby $1.2 billion in cash. And the purpose and the goal here is really to dive into the success story. I know a lot of you have your own companies or thinking about companies that you're going to start. And the purpose here is to try and glean from this story examples, lessons about what worked, what didn't work, what were the risks that they faced, how did they overcome those risks, so that you can apply that to your own companies and use those lessons as well. And without further ado, I know you're not here to hear me talk, you want to hear the panelists talk, so that is the goal. I'll reserve time at the end for Q&A, and I know that we asked prior to the session, we sent out an email where we got a good response on what questions people wanted to hear asked, so I'll make sure those get addressed as well during this. If there really is that burning question that's on your mind while we're hot on that topic, feel free to raise your hand, we'll try to get to you. If we don't, we'll get to you at the end. But let's meet our panelists. So David is the CEO, founder of Yammer. We have Jason Green from Emergence, who an investor in Yammer, board member of Yammer, and George Zachary from CRV, Charles River Ventures, also a board member of Yammer. I'll let each of them give a better introduction of themselves. David, you want to start?
Sure. So, I founded Yammer, and like Dan said, in September '08. It was spun out of another company I'd founded called Genie, which I started back in 2006. Prior to that, I've done a couple of different things, but I guess in the internet space, I was the COO and product leader of PayPal, from early 1999 through to 2002, when we sold the company to eBay, and I've also done other things like produce movies and stuff like that.
Thanks.
Jason Green with Emergence Capital. I was one of the 3 co-founders of the firm about 10 years ago. And Emergence is unique in the sense that we focus 100% on enterprise SaaS companies. Our first investment was Salesforce.com, SuccessFactors, Box, or some other investments in addition to Yammer. So I think we're unique in the kind of narrow scope of the activities that we do in terms of our strategy. I was in the venture business about 10 years before founding Emergence with 2 other great firms, US Venture Partners and Venrock Associates, and then had a mix of consulting and operating experience before that.
Excuse me. I'm George Zachary with Charles River. I've been in the venture business since 1995, invested in 23 companies. Yammer was number 20, I believe. I am technically the original investor in Twitter. I was the investor in the predecessor company, Audio, which has an interesting analogy to the Genie Yammer spin out, which we'll talk about a little bit. I'm also the co-lead investor in Millennial Media, which is the biggest, actually second biggest mobile ad network in the world, behind Google now, and a very exciting company called Udacity, which is the fastest growing online university.
Great. Thanks, everyone. So let's dig into it. Let's get rolling. And George, since you mentioned it, let's start chronologically at the beginning, because it wasn't a typical way. Yammer didn't start in the usual way. It was a spin-out company spun out of another Orrick client that David founded, that George had invested in at that time, called Genie, which was a consumer-facing site, which was a wiki site based on genealogy, started in 2006. So the spin-out occurred in September of '08. David, why don't you start on that? What was the lead into that? Why did you decide to develop a new company, and how did that idea develop?
Yeah, so I founded Genie in mid-2006. We launched a product in January 2007, and we got off to a really hot start. I remember, like, first month we launched it, we Then we got something like 50,000 new users, which was a lot kind of in the pre-Facebook platform days. But nonetheless, as 2007 went on, I became progressively more concerned and kind of paranoid that Genie wouldn't be a big success because our original thesis for starting the company had kind of been refuted. And our thesis was that we could create this virally growing family tree and then layer a family social network on top of it. You got to remember at the time, mid-2006, MySpace was the dominant social network, and Facebook was just for college students. And looking at MySpace, it was pretty clear that families were never going to use it. The content was just kind of too raw and unstructured. But around by mid-2007, I think it had become pretty clear, at least to me, that Facebook was going to eat that family space. They had kind of opened up registration beyond college students. I think they started to launch their platform. And so I began to become concerned that Genie couldn't really become a big company anymore. And so I think rather than kind of waiting for the writing to be on the wall, we could have waited like another year or two before this was like absolutely manifest. I started kind of noodling over alternative ideas. And really I was thinking about the idea for corporate social networking, which was kind of just a hop, skip, and a jump away from what we were currently doing, really throughout all of 2007. And by January of 2008, we had basically decided to pursue this idea. We started coding it, and then we launched it about 8 or 9 months later at TechCrunch.
Right. And George, let me turn to you, because you were an investor in Genie. And what was your impression when David came to you with this idea? I mean, essentially, it was an ask to, you had put money through CRV into Genie. Now it's a big pivot, a completely different space. You already built the Genie team. How did you feel about that? How did you feel about going to invest in a new, now to be an enterprise, a software company? What did you think of that as an investor at that time?
It might sound nutty, but I was super excited. I was saying very large, kind of crazy things to David about it, saying we should go for it. And I was an investor in a company called Critical Path in the 90s, which is the biggest B2B email company that was a web, we hosted email for corporate companies. And I remember backing that, which came out to be a multi-billion-dollar exit, because I had seen the success of Hotmail. So, messaging tends to recur, and I was thinking someone's going to do this right for business. And out of the 23 companies I've backed, I would tell you that David's probably the best founder I've ever backed. And that includes the first investment I made with my other partners, which includes backing Elon Musk in 1996, January. So, I told David, if you're excited about it, do it, because I have complete conviction in you.
So then there's really a double down based on David.
Yeah, I believed in David pursuing that vision.
And then, George, before you were an investor in Twitter, and Twitter also had, I guess you could call it a spin out. How did that impact your thinking on this, or how did it?
It was a different situation. We were a company called Odeo. We were doing podcasting, and Apple announced podcasting, and then we had no idea what we were doing. And Jack Dorsey came up with the idea for Twitter. It wasn't Evan's or Biz's idea, even though they get a lot of the credit for it. And that spin out started really in a period of disorganization of Odeo. There wasn't a clarity of saying, this is what we should do. David had clarity about that. So I had a lot more confidence rebacking David than I did in the original situation with Twitter.
Good. So then continuing that story just a little bit ahead, so David, you were then CEO of both companies. You launched Yammer. You won TechCrunch 50. You had a team that you brought in for Genie, for a different type of company that had more consumer-facing DNA. You moved Yammer up to San Francisco. How did you go about then, with this new idea that obviously was getting some traction, recognition through TechCrunch 50? How did you go about building the new team, instilling this new enterprise DNA in this company? You hadn't been in an enterprise software company before. Your experience before was with PayPal.
Right. So I think when we started Yammer, one of the things we were excited about is that we thought we could disrupt the enterprise model or enterprise sales model by making enterprise software viral. I mean, that was really part of the original vision. And one of the things I look for in a product is some sort of inherent virality or some other means of distributing it. Because you can build a great product, but if it doesn't have a way of getting distributed, no one's ever going to find out about it or use it. So from the beginning, we always saw ourselves as disrupting the enterprise space by using consumer internet techniques. So virality being the most important, but there were other things we did that were sort of consumer standards best practices that, like just the use of analytics and testing in making product decisions and rapid release cycles and iteration. Those are things that every consumer internet company does, but enterprise software companies historically haven't done. So we were excited about our consumer DNA. We thought that was actually an advantage. My experience with PayPal had been that not having any banking DNA was actually an advantage, that sometimes being too beholden to the prior modes of thinking actually gets in the way, that you can bring a fresh take to something if you don't know too much about how it's supposed to work. So that was kind of, I think that worked for the first year and a half. By the time that we started talking, I think, to Emergence, and we closed, so Jason was our second investor after George. That financing round closed in January of 2010, so we started talking a few months before that. I think by that point it had become clear that there were certain things we were missing, and we actually needed to supplement our consumer DNA with some enterprise DNA. And the big thing, I think, was sort of enterprise sales and marketing. I think one of the biggest learnings from Yammer over the past 3-4 years is that virality gets you in the door, but it doesn't close the deal. You still need some sort of sales team to go in there and actually close the deal. So, use like a metaphor, the virality are like your scouts, and they'll go up and they'll kind of go up the hill, and they can kind of be the first guys to kind of claim the land, but unless you bring your whole army up behind it and then build a wall, then that territory is very easy for a competitor to come in and take and kind of blow you away. So that's not to say that virality wasn't a huge advantage. It made our sales operation so much more efficient because the initial interest came from companies in this form of virality. We never had to spend any meaningful amount of money on traditional marketing and lead generation. We kind of developed this custom pipeline or process where the leads all came from viral use of the product. And so that was, I think, tremendously innovative. It was the thing that gave us a huge edge over companies that had been around longer than us, like Salesforce or Jive. But I think it was an important learning that we did have to kind of have some of that enterprise DNA in our company.
Got it. So Jason, you were the investor in January 2010, and your background is predominantly in the enterprise space. So what was your analysis as an investor with David coming to you and looking at this company that had spun out from a more consumer-facing company, and then with the challenges that David just said, they had a viral platform, but had to kind of develop into a more secure kind of enterprise type company?
Yeah, so back in kind of 2009, we at Emergence started thinking about, we're very thesis-driven as well, and one of the advantages of being on the enterprise side now is you can look at the consumer technology world, which really leads the enterprise, frankly, in terms of adoption, and look at those trends and then say, how are they going to apply into the enterprise? So we had the benefit of looking at Facebook and seeing the tremendous growth there and saying, how would this now impact behavior and adoption within the enterprise in terms of how people are going to communicate and collaborate? So we looked at probably 8 to 10 companies, broadly in the enterprise social networking space. And it was very clear to us when we met David, two things. One is that the quality of his thinking and his track record around building great products, having come from PayPal and done that successfully, really differentiated him from the crowd dramatically. And the second thing was he just had tremendous traction in terms of the adoption of the product. And while there wasn't a tremendous amount of revenue at the time, I think less than $500,000, there was clear adoption by companies of all sizes, small, medium, and very large companies. So for us, it kind of fit the thesis that we were going after. We had done a pretty good survey of the market and identified Yammer as clearly the company that kind of had the most momentum in the space. And to second some of George's comments, while I didn't have a relationship with David already, it was very clear when I met him that this guy was pretty exceptional. And I've been lucky enough to have been involved with probably half a dozen billion-dollar kind of exits in my career. This was by far the most fun one for me. And I'm kind of sorry it's over, frankly. This is
Me too.
But obviously can't argue with the outcome here. But it really was. It was one of those opportunities you look back and you go, it really fit the thesis. We had a great team. We had the traction. And I think, as David pointed out, one of the things we felt we could bring to the table was to help the company make this transition from this beautiful jewel of a product-driven company to more of a sales and marketing engine that could layer on top of it and really create 1 + 1 = 10, in this case. And so that was really our thesis in going in, and really what we spent a lot of time focusing on the company with.
Got it. So, David, I want to go back to one of your points, and I'm kind of, again, following the trajectory of the company chronologically. So you have in 2 investors now. I remember at this point, going to board meetings, you brought up various risks that you face, and one was commoditization of the product. Can you explain what that is and how you dealt with that? I think it goes back to what you were saying, which is dealing with the virality and kind of putting on top of that the layers of the army to come back it up. But there was a risk, because there were competitors out there. It wasn't that you were the only company going after this space. There was Jive, there was Chatter, which was Salesforce, with the Super Bowl ad and all was out there. So how did you deal with this kind of commoditization issue? Explain it and how you wanted to address it.
Right. So I think all software products essentially face this risk, which is that software is very easy to copy. And I don't mean pirate. I just mean that anybody can look at what you've done and build their own version of it in their own way. And so the key for anyone creating software or a software business, especially if you want to charge money for it, is to figure out what about your business is non-copyable. There's libraries of open source software out there that probably have eradicated lots of business opportunities for once successful companies. And it's not just the open source thread, it's also large companies adding your product. Maybe it's not quite as good as what you did, but they're willing to give it away for free as a loss leader. Kind of how do you deal with that? So I think you've got to figure out, is there some sort of network effect, or is there an effective scale, or something like that that you can take advantage of. And there are a bunch of different things that we tried. But to bring it back to kind of the fundraising, people ask, well, when you raised $85 million, that was about 3 months before the Microsoft acquisition, we did an $85 million funding round, but we did 5 funding rounds total. We raised $142 million. People would ask, well, didn't this increase your risk? And my view on it was always, no, it decreased our risk. That raising more money would not only increase our return, but also decrease the risk. And the reason is that if we could move faster and be bigger, not just from both a product development standpoint and a sales standpoint, there was much less risk of being commoditized, because our product could get much further ahead. From a sales standpoint, we could close a lot more deals much faster. We could just kind of win the market. It was very important to create distance between us and the number 2 and number 3 and so on in the space. And so one of the best ways to do that was just to put the pedal to the metal and just grow as fast as possible.
All right. That's an interesting point, so let's focus on that for George and Jason. So I'll play devil's advocate on that. If I'm an investor, maybe I think, gosh, David's raising every 6 months, a healthy clip of money, spending it at a healthy clip. Doesn't that push the bar on what kind of exits you're looking at as an investor for your return? I mean, you have to get a much higher return where the investors will be satisfied, the founders would be satisfied, the employees would be satisfied, and ultimately you get a limited subset of potential acquirers, if that's what the liquidity event's going to be, that can actually have the resources to afford such such an exit. So doesn't that put you in a little bit of a box, or how do you look at that as an investor?
Well, personally, having an entrepreneur that is that ambitious is one of the greatest things you can find as an investor. The hardest thing as an investor is when you put all the money and effort into an opportunity that gets sold for a much lower price or doesn't have that level of ambition. I mean, the great returns in the venture business come from great entrepreneurs who have huge ambitions. And so the harder thing is to find somebody who's willing to take that level of risk. Part of it, I think, was frankly, his prior success allowed him to maybe think a little bit bigger about this opportunity than maybe he would have otherwise. But I personally was very excited about the level of ambition. We had acquisition offers, frankly, soon after we invested in the company. It would have been a great return for Emergence in a very short period of time. And I was all for putting the chips on the table and trying to build something really special here. I also wanted to just re-emphasize one point David brought up, which was the level of urgency that I saw in this company was quite unique. And it was almost hard to keep up with everything that was going on with this company. And every time we had a board meeting, there was such dramatic new progress in innovation on the product side, on the vision, on fundraising, on the team. I mean, there was a level of intensity and urgency here that is in top 0.1%, I would say, of the startups I've seen. And that mentality, I think, led to the great success. It's just, he was not resting on his laurels. He was not saying, hey, we just raised, whatever, $20 million at a great step up from our last round. He was thinking about, how do I raise the next, $50 to $100 million round that's going to position us for huge success.
As the lawyer, I can say yes, there was a sense of urgency and plenty to keep us busy. David, thank you. So George, on that point, you were the earliest investor, essentially, that led the first VC round in Yammer. Did you feel the same way as far as what Jason described as, as long as there's this incredible sense of urgency, this incredible progress, that it's worth it to raise this money, push the bar higher, to beat the competitors, to hire the best people? Is that how you looked at it, or was there a part of you that said, gosh, maybe we should slow this down, or not?
Why ever slow down? I never felt that way. I just continue to gain more and more enthusiasm, and I used to write up my notes from my partners internally into our limited partners, and I kept getting more and more excited in what I was telling them. So I felt like we were winning and really monopolizing the market by beating out these smaller competitors. So I saw us basically taking off, and you could see it in that round. We originally went out to raise $50 million, and within 3 weeks, David had $120 million of interest and cut it back to 85, because people realized this is going to be the company that wins. So people wanted in, and that's a trend that we see now. When the company looks like it's going to win in its domain, people just pile in, and they become much less valuation sensitive. They want to be part of the winning company. And people who might have thought, oh, I don't know about the Series B or C at a certain price, just say, oh, okay, I'm in because it's going to win. And we certainly had some of those. So.
Yeah, I mean, so the round you're talking about was the last round we did, which was in March last year. Yeah. So we had tons of interest, but before then, we never had more than 1 or 2 term sheets per round. It was actually, I would say, it wasn't necessarily. I would say it was actually semi-hard to raise money for this company, in the sense that we always had somebody who's willing to step up, give us a term sheet, and we closed it quickly, but never more than 1 or 2 until the last year.
David doesn't know what raising money hard is, okay?
Well, I guess I'm trying to give you guys credit because not every investor saw this as a good opportunity.
One other point I wanted to make in terms of the level of conviction that allowed us to go out and raise that amount of capital is the underlying unit economics of this business were really solid. And there was a couple early indications of metrics that we looked at that were kind of best in class in this business. One was the ratio of kind of free to paid users. And typically in a freemium model, you'll see like low single digit, 1%, 2%, 3% kind of conversion rates. And those are fairly some good companies. Yammer had close to 10 to, I think it was at one point 12 or 13% conversion from free to paid, which was extraordinarily high. And the second thing was we were seeing tremendous interest in renewing business at ever increasing prices from the customer base. So it gave us a ton of conviction that once we landed these folks, that we would continue to monetize more of those customers over time. And so you want to, as a SaaS business, invest as aggressively as possible when you understand those unit economics. When you know $1 of sales and marketing is going to bring you at least a dollar or two of annual recurring revenue, and then more importantly, lifetime value, let's say of $5, $10, right? So you can be very, very aggressive once you have conviction around that.
And were those metrics clear at the time you invested, Jason, or later on? Because you came in and
it was early. It was very early, and the monetization metrics around this conversion there was some early evidence of that. I mean, it was already well above this low single digits in terms of conversion. But the unit economics of investing in sales and marketing and then seeing that turn into ARR wasn't there yet. But as we saw the renewals start to happen and the bigger companies starting to adopt the product, that's when we got real conviction about investing more heavily in sales and marketing.
So David, at this point, with your wallet's full of cash and you're developing the product, you're then, it seemed to me from going to board meetings, watching the company's evolution, there's a fundamental shift. You're no longer a startup. You're growing out a much bigger team. You're bringing in management level folks. Can you talk about what you look for as far as hiring the team, building that, and how important that was, how you were able to grow so fast to take advantage of this opportunity and the metrics that Jason just mentioned?
Yeah, so like I mentioned earlier, one of our biggest learnings was the need to create an enterprise sales machine, and that was probably the toughest challenge the company faced over the past, say, 3 years, because we didn't really have that DNA in our company. I'm not a sales guy. My background's more in product, and at PayPal we had I think we had 6 salespeople, and they were in a basement somewhere, and it just wasn't really part of the model. So it wasn't something that I knew a tremendous amount about, and we had to. There were some iterations before I think we finally got it right, and so the thing that I think we did is around Q4 of 2011. So it was really only about 6 months before we did the deal, the acquisition. We brought in a very senior sales leader from Salesforce who had 10 years of cloud selling experience, and he started immediately making a huge impact. He's only been at the company for a little bit over a year now, but I can't really. It's just it's kind of like a night and day. And then he was able to bring in other people who kind of knew how to scale a sales organization. So I think that made a really big difference. Now, all that being said, one of the things I think he had to learn was how to take advantage of this new kind of viral model. And so it's not like we were just implementing Salesforce's sales model, but we definitely took a lot of their best practices and then adapted it to our needs.
Kind of tangential. I remember one point you telling me, and what if you still think it's true, that just as far as a small, simple strategic tip was bringing recruiters in-house was very important for you to hire the quality people so quickly. Is that still something you would recommend?
Yeah, I mean, I believe in bringing recruiters in-house, but I believe in bringing everything in-house. I think we even tried to hire you at one point.
My mistake.
The only mistake you made in 4 years was not coming on board. Otherwise, everything you do is perfect. But actually, is Joe Chung? I saw him here earlier. There's Joe. Joe built our first recruiting team at Yammer. He did an awesome job. So the idea behind just bringing things in-house is this is one of the first things I had to kind of learn or really unlearn. In 1999, when I left McKinsey and joined PayPal, one of the shibboleths you're taught in the consulting world or business school or something like that is that you should just be outsourcing everything. And what I've learned is whenever we outsource something, it didn't get done right. So we just stopped outsourcing stuff and decided that either you hire the people to do it and you control it yourself, or you don't do it at all. I mean, I think that should be your mindset going into a startup. You just can't get, not only the quality, you can't get the speed that you want when you're outsourcing things to contractors. So at a certain point, when we knew we had to scale, we brought recruiting in-house, and that was very important.
Yeah, the other thing they did remarkably well was on the engineering side. I mean, in addition to the sales side, but Adam Pizzoni, who should also be on this panel, really played such a key role, I think, in establishing a culture and a technology team that was really the envy, I would say, of a lot of folks. And when we look at why folks like Microsoft, I think ultimately one of the assets that they really saw was the platform, not just the technology platform, but the platform of this team that Adam and David had built. And I don't know, again, Adam is extraordinary, just like David is. But there were a lot of things that I saw them do that were quite unique on that front to build a place in one of the most competitive, economic environments and labor environments we've seen since I've been in the business, to recruit just an A team.
Yeah, I mean, I just echo that. Give a shout out to Adam, who did an incredible job. He's probably the best technology leader I've worked with. I mean, well, let's see. He's right up there with Max Levchin, who co-founded PayPal. They're very different personalities, but they're both equally great in their own way. So Adam did an awesome job. One of the advantages of doing the spin out from Genie is that when we did that, I could kind of reconfigure things exactly the way that I wanted. And basically, Adam, he was an engineer at Genie. He wasn't leading a team yet or anything, but he was just the perfect guy to run this project. So we put him in charge of it, and then he coded a lot of the first version himself. And then when we spun out the company, he became the CTO.
What did you see in Adam that you thought was really unique? Because I think that was a bet that you made,
right?
Not an obvious track record of having built a huge engineering team.
It was, and David, I think even later I saw it maybe on Quora where you posted that Adam had the ideal qualities for a CTO that's so rare to find.
Right.
Kind of a unique combination of technical skills, leadership. So just what Jason said. How did you see that, so early on?
Well, there's three things you look for in a co-founder CTO. And one is they've got to be a great coder or engineer themselves, because even if they're not doing that much coding, and usually they do a lot in the early days and they don't do much at all in the later days. But it's the other engineers need to be able to look up to that person. And unless they're a great coder, they won't get the respect of the engineering team. The second thing is they need to be able to kind of build out the engineering organization. So as we know, the toughest thing to do in Silicon Valley right now is build an engineering organization. It's way harder than raising money. So you've got to have somebody who can do that. And preferably they're managing the team, they're leading the team themselves as well. Sometimes I see it split where you've got a CTO who's providing technical leadership and you have a VP of engineering who's providing people leadership, but I don't think that works nearly as well as when you've got one person doing both. And then the third thing is that person's got to be able to engage at a board level, participate in board meetings, and which means they have to be fundamentally strategic. So they can't just be great at technology. They got to be able to weigh in on the strategy of the company and participate as an equal in the board meetings. And if you don't have that, you're just missing something important, I think. So I just saw those qualities in Adam pretty early on. Even though he was, he joined Genie as an engineer, but he had actually been an engineering manager at his previous company, and you can kind of tell, at a company who the great engineers are. Even if you yourself aren't an engineer, you don't have to look at their code. Just look at who everyone is going to.
George, just switching gears a little bit, this is all too easy and nice. There are risks involved here. You were, again, the earliest one in. Jason mentioned along the way there were offers for acquisition that were turned down. What were the risks that you saw in this company? Obviously, it's been able to raise capital. You have a great founding team. You're able to hire the right team. And it seems to be gaining traction. But you've been doing this for a long time, even though you look incredibly young. I say that every time I see you. It's quite remarkable. But I don't know what the secret is. I want to invest in it too.
All the Greek food.
The Greek food. But what, you've seen life cycles of companies that have made it and not made it. Did you see any risks or any kind of worry signs that you were concerned about? Or maybe you should have pursued that acquisition offer more closely or not? Anything like that?
No, I never thought that about any of the inbound offers, that we should take any of them. For me, it's always what do the founders and leaders of the company think about the acquisition, because I think they always know better than the investors. They're closer to the problem. They're closer to the opportunity. So their input to me is like the main signal. In terms of the main risks, I think there was product adoption risk, which we saw that people were using the product, which is great. Then there was the product roadmap and what we're going to go into. There's some risk around that, but we were basically penetrating a ton of companies, and we were basically winning the Fortune 500. So this viral spread was working. I felt very comfortable with that. The question was, how are we going to drive more revenue? And then sooner or later, how are we going to basically deal with inbox functionality, not just enterprise social networking? And Microsoft has some inbox functionality, as we know. So, there was some product risk around that, but in terms of team risk, I saw almost zero. And I just had conviction that it was a great market. And my belief is if you can control messaging, you can basically disintermediate enterprise software. So I saw that we were on this path to basically owning messaging, and that was incredibly exciting. So I never really felt worried.
One interesting fact is that after we signed the term sheet, I think it was November maybe of 2009. Salesforce has this annual conference, Dreamforce, and they launched in either late November or early December their version of Yammer, which was called Chatter, and it was a big event. And when Mark Benioff gets on his bully pulpit and starts marketing something, people pay attention. So here we were, having just signed the term sheet, and all of a sudden Salesforce says this is the future of our company, enterprise social networking. And I must say, it gave me a little pause at that moment. That here we were, funding this company to going after really the Goliath in the SaaS space. And what I came back to that gave me, again, conviction was, fundamentally focus really does matter. And Yammer was 100% focused on making this the best product in the world, and everybody in the company really was aligned around making it successful. Whereas Chatter, as much as Mark, put this out front in terms of marketing to the company and the world, it was still, just an add-on. It was another product in the mix, right? So they had CRM, they had Service Cloud, they had a bunch of other things going on the platform. So I felt a company that was world-class, had world-class people, that was 100% focused on this and executed well, would beat the large incumbent. And that is the nature of this whole ecosystem, the entrepreneurial ecosystem, is believing that as a young company with a lot less resources that you can out-execute and out-maneuver companies that are much more established. And then there was another point in time, I would say, probably a year in, where I felt that we were getting a ton of traction in terms of the freemium model and converting some of the larger customers. But there were two things happening. One was we had competition from Chatter. We had a company named Jive that was an independent company that was starting to create some more competitive threats. And we had to make some decisions as to were we going to own the high end, or were we going to kind of go after kind of the mid-market and SMB, and how would we monetize that part of the marketplace? And we hadn't figured that out yet. So there were really some pretty key strategic decisions that we had to make, and I think David rightfully, navigated a lot of these key decisions along the way, but we could have made some wrong decisions, frankly, on that front. Investing in the sales and marketing capabilities to really go head-to-head with Jive and with Salesforce was really key to the success. So.
Yeah, and by the way, I was worried too. In January of 2010, which I guess was right after you guys invested, they launched the product with 2 Super Bowl commercials, and it was a huge marketing push behind it. And it was very worrisome. And I think in hindsight, Salesforce made some mistakes that bought us a lot more time to get out in front. When they first launched the product, it was $50 per user per month. I think we were charging $3 or $5 or something back then. So they dramatically overpriced it. And then it took them a long time to figure out that it was overpriced, and it gradually went down, but then it went down to like 15, and we were still like 5, and so I think that like bought us like a whole another year or two or something. And then eventually they figured out they should just be giving away for free as a loss leader. So they did, but by that point we'd gone from a 20-person company to a few hundred, and so that time was really critical. And our product had gotten out a lot further in front of them.
Just on that, I always meant to ask you, David, so what was it as a CEO going from a company of 20 to 200? How did your role change? I mean, your most precious resource is your time. How did you decide to focus your time? Were you focused then on sales, on meeting with customers? You had a team being built and built around you that was world class. How did you'd make decisions with your time on how to focus effort? You're obviously a master at product as well. Did you stay involved in product or move more to sales?
I think what happens is as these companies grow, your role becomes more meta over time. And what I mean by that is, in the beginning, I just made all the product decisions. So, it was me and a handful of engineers in a room, and I kind of wrote a product spec. And then eventually you get too big. It doesn't scale for me to micromanage the product. So you hire product managers, and so you focus on trying to get the right people in those roles. And then eventually you get so big that you can't even interview everybody. And so then it becomes about defining a culture and a value system so that the right people can be hired without you even being part of it. And so like I said, your role just becomes more meta over time. I think at the end of the day, I think what a CEO does is pattern recognition and exception handling. So pattern recognition is as soon as you spot a pattern or trend or process or need, you create a system or you hire people to fix it. So you recognize that we need an enterprise sales machine, you put that in place. Once you've kind of created that, you've delegated it, and now you can kind of move on to the next thing. And so really what you spend a lot of time dealing with are these exceptions, things that don't fit into any clear pattern. And it can be something, it could be a friction that's created between the sales org and the product org. They're disagreeing about something. Something doesn't smoothly fit into the machine we've created. Or we're hearing certain things from customers that we're not addressing, or there's a customer service problem or whatever. So I end up spending a lot of time on like very high level stuff and very low level stuff and not much in the middle. The super high level abstract stuff is just the pattern, spotting the patterns and delegating, and then the minutia is like all the stuff that's not fitting into the paradigms and trying to figure out how to process that and fix that.
I have one question for you. Given we're all now just deluged with tactical stuff, responding to hundreds of emails a day and Twitter, how did you find time to stay up at that high level, the strategic level, to really think through some of these key moves? I mean, did you put in place any kind of a structure that allowed you to have that space?
Well, I mean, I really look for the people who are reporting to me, I really look for them to be strong managers who are strategic and kind of own their organizations. So, whether it's Adam Pizzoni running, R&D or, Obran running sales, I don't really meddle on a day-to-day basis with what they're doing. So that really creates the space for me to, like I said, go either really abstract or really detailed. And people kind of wonder, what are you focused on all this minutia for when you're the CEO? Because it would seem, I guess, probably to other people that I'm just like randomly interjecting myself in things that don't matter that much. But they're actually things that I felt like they would give me the insight to actually lead to whatever the next strategic decision was.
One interesting thing I remember, very specific, the first time I visited David in his office, he was talking to an engineer outside of his office, and he was arguing with the engineer about that the text was off by 3 pixels, on the screen, and I was kind of just shocked that he would care, But it really,
I just can't help that. That's actually, I like to rationalize that and say it's actually like a CEO function. It's not. It's just I can't. To me, the product just has to be as perfect as possible. And
but that obsessiveness is what led to the virality of that product early on. I mean, getting that product right. One of the things that differentiated Chatter, for instance, from Yammer was just the ease of use and this kind of inherent elegance of the product, and that comes from someone. It doesn't just happen, right?
Well, you want to make sure that your storefront is clean. I mean, it's sort of like the best McDonald's are the ones where like the manager is like cleaning the bathrooms and stuff like that. And you know, and so it's, you know, when I see things that are just off in the user interface, to me that's like a piece of trash being on the floor of like your, you know, your store. I just can't stand it. So, you know, again, I don't know. It's maybe it's not like a rational CEO thing, but I just, you know, it's.
Did you give that up over time, though? I mean, were you
well,
able to
so what
kinda-
happened? Yeah, so what happened is that we actually figured out a good way to deal with it, which is so I used to just show up. We have we have designers and a design team, and I would just kind of randomly walk by their cubes, and I would kind of peek over their shoulder and then start, you know, messing around with the interface. And apparently people found that kind of jarring, you know. CEO would just kind of stop by, and especially like once the team got, you know, to be a couple hundred people, and, you know, a lot of these designers didn't expect to interact with the CEO that way. So what we did is we created product review meetings where, you know, every week or two we would just have like a, you know, 2-hour meeting where the product managers and designers would present what they're working on. And so we just created like more structured opportunities for me to present feedback, so I wasn't like, you know, causing people to like go, you know, CEO is like, you know, getting involved in my work.
Okay, so let's jump to the nice ending of the story, or the beginning of the ending of the story. So I want to cover the sale to Microsoft. And the question to me, I always do believe that companies are bought, not sold. Is that true in your experience? And how did you get, you know, Microsoft was obviously interested, from being interested to being incentivized to move now and give you an LOI that's, you know, in Godfather terms, an offer that you can't refuse. What is it? How does that switch from companies sniffing around, interested, picking your brains, following you, to actual movement towards a real acquisition, no joking around? Let me start with you, David. We'll go down the line.
So I completely believe that companies are bought, not sold. I mean, the short answer to what did you do to get Microsoft interested is nothing. I mean, nothing targeted at them. I think they had seen enough of us in the marketplace and heard from a lot of our mutual customers, and that's what got them interested in us. And so they really came to us, and you know, our first meeting, Adam and I had dinner with the president of the Microsoft Office division, and along with the VP who's in charge of SharePoint. And they pretty much flat out told us they wanted to acquire us, I mean, pending them just learning a little bit more. So then the question was, okay, well, you do go through all these questions about, are they serious? Do they just want to kick the tires? They just, I mean, they want to learn what we're doing. You know, there's obviously potential competitive risks, so how should we handle this? And I guess our view after talking about it internally, just me and Adam for a while, was that we would actually err on the side of being open, even though there was a competitive risk if we didn't end up doing a deal, just to kind of qualify them like quickly. So we agreed to basically spend an entire day with them, and we would, Adam and I, kind of walk them through our business and kind of how it worked. And we ultimately figured that, you know, what we're doing was sufficiently complicated and difficult that even though they might learn a lot, it still wouldn't be something they could like replicate anytime soon. So we basically spent a day with them, and then basically told them, like, look, we've opened up the kimono. You guys have to decide. We're not going to spend a lot of time in a process with you. We're building a standalone company. By the way, we weren't looking to be acquired. That wasn't our mindset. We had just raised this big financing round. We were very much in a mindset of, you know, we're building a great standalone company. So, you know, we're not going to engage in a process. You just tell us, like, flat out what you want to do. And the result of that was, within a month or two, I think there was like one follow-up data request, but basically they then got us a term sheet. And that kicked off formal negotiations.
Right. So George, go to you. And is that kind of echo chamber that's created with Yammer's customers, there was kind of a feedback to Microsoft that continually got them interested without the company itself? Because as David said, I do remember the company was not focused on on exiting at that time. Is that what you see with other companies? Was it unusual how it happened with Yammer, just based on your experience?
No, no, it's pretty usual. The companies that get big exits are ones that are pursued. They're not ones that are desperate to sell. The ones that are desperate to sell basically go to book value, if you're lucky.
Like dating.
Yeah, that's right. That's right. And you have to, you can't look to sell. It's kind of like harvesting. The liquidity environment's like the weather, and you take advantage of it when there's a good situation. If not, you still have to keep building the company. If there's nothing there, and someone gives you an offer, you're like lucky. But all the companies I've been involved with where the founders say, "Oh God, we have to sell now." Who do we sell to? Those have all been bad outcomes, every single one. And I think what happens, I worked in a publicly traded company in the early 90s called Silicon Graphics, and I dealt with some of the acquisitions, which are small, which is one of the things you see in management teams of very large companies is they have this feeling that they've somehow lost their way, that they don't know what to build, and they're nervous about it. So there's a psychological dynamic going on in those management teams where they think that we have to pursue the leader. So if they meet a startup to think that is like desperate, it mirrors their own internal desperation about driving their own public company. And like, crap, we don't want more desperate people here. We already have enough desperate people here. We need ballsy, driven, forceful leaders. And a company that's that way, so they look for that and they're attracted by that. They're looking to pursue and get something versus be sold something.
My experience is exactly aligned. I mean, over my career, I mean, I've been fortunate that most of my exits have been IPOs versus M&A, frankly. And the ones that have been M&A, this is actually one of the better outcomes I've had. And the reason is, I think, because we really took the mentality of trying to build an independent company here and not be sold. And to add to George's kind of internal mentality and dynamics, when somebody makes an acquisition of a company, they're really betting their career on the outcome of that acquisition. And so the amount of trust and greed that has to go into that kind of a decision is tremendous, is enormous. So the idea that you're going to convince somebody of that is really a pretty far stretch, right? So what I think enabled us to be so successful was, as David said, there really was very little effort involved with getting Microsoft to the table. What we did a spectacular job of, I think, was managing that interest in a very efficient and effective way. And part of it was having some great advisors around the table. But this was it was remarkable, but we went from LOI to signed definitive agreement in 30 days and then closed within the next 30. Right. Is that correct? So 60 right. days.
60 days from LOI signing to closing.
For a $1 billion plus deal. I mean,
I didn't sleep much.
That's remarkable.
So David, when we talk about that, feeding off of what Jason said, how do you run an effective and efficient process? At the same time, dealing with the concerns that you mentioned before, where you're worried, you still always have to be worried. Microsoft's a potential competitor, doing this extensive due diligence review of you. How do you manage the process with your advisors, with your team, and with Microsoft?
Yeah. So I'd been through this before a little bit with PayPal. We ultimately sold the company to eBay, and there'd been a few false starts with that process, and then eventually the PayPal deal got done. It actually got done over a July 4th weekend in 2002. I think me and then the CFO of eBay and a couple other people kind of got together. Like, I think the holiday started on a Wednesday, and then by Sunday we had negotiated a definitive agreement and announced it to the market on Monday morning. So my view on this stuff is it either happens fast or it doesn't happen at all. And certainly from the point of view of the startup, you have to have the process be fast because you can't afford to lose months of time. And by the way, one of the things I've noticed with all these M&A things is that everything at the company stops if people, because they're wondering, well, what's going to happen? What's going to happen to me? And so it has to be an M&A process that actually doesn't happen can ruin a company, I think. So you've got to keep it brief, and then you've also got to keep it contained. And so I think until we had a definitive agreement, I think we pretty much just limited the people who worked on it to me, Adam, and then Mark Woolway, who's our head of finance, basically our CFO, to that group. And my view on it was just, these things are pretty fragile in general. I mean, there were a bunch of people who, George and Jason mentioned, there were other people who kind of approached Yammer previously and wanted to acquire us and stuff like that, and it didn't make sense for various reasons. But you never know how serious an acquirer is, and these things are pretty fragile. So I just think you got to keep them short and contained.
Then Jason and George, just from your point of view, I mean, I know at the time maybe it was my own. I'm kind of projecting my own feelings. There was a bit of kind of sadness, I think, at the sale of, this could have been an IPO company. It could have been a standalone. How did you feel about the sale, both in terms of just as an investor's perspective, just with your investor hat on, and also being a board member and watching this growth and contributing to this growth over several years? What was your view about it at the time?
Well, as I mentioned, we'd had some interest in the company prior to this, and it felt really premature at that time. So that decision was quite easy. This one was tougher because obviously the magnitude of the deal, and it was clear that Microsoft was serious, that they weren't fooling around. And we knew that there were probably a couple ultimate buyers for this company at that kind of level. And not a tremendous number, but a small handful, and some of them had competitive offerings already or had made acquisitions. And so when you start to think through, if we are going to take an M&A kind of exit for this company, which is our most likely buyer and who has the most strategic potential value of making the acquisition, Microsoft was pretty high, if not number one on that list, and they were clearly interested. So to George's earlier point, you really do strike when the iron is hot. You can't create that level of interest. That has to be there, and you have to take advantage of it when it comes. And I think ultimately, I think as investors, we had a tremendous financial return from it. But I kind of looked to management to make that judgment call at the end of the day. If David had said, I want to keep playing, I want to build an independent company, a public company, I honestly believe we could have built a company worth a lot more than we sold to Microsoft ultimately, but it would have taken a long time. And there would have been a lot of turns and twists and risks along the way. And frankly, the management team ultimately is the one that has to live with that sacrifice, frankly, of that run and have the passion to do it. So I kind of let them lead in terms of the ultimate decision. Personally, again, I had more fun in that 2.5 years with Yammer than I've had in a lot of my investments, and so I miss it. I do miss it, but I also feel great about Yammer now continuing on, as a product with Microsoft behind it. I think it'll be a product that does ultimately change the world, hopefully.
And George, you mentioned, you were the first one to double down on David, essentially, going back to the beginning of our conversation on the spin-out. So to see this happen, again, it must have, been obviously kind of fruition of what you kind of had dreamed and hoped would come. But what were your thoughts about it, both from a board perspective, a human element, and also as an investor?
If there was any sadness, I guess I was the happiest sad person ever. My only sadness, honestly, was I love working with David. He has been a personal friend of mine well before we got into business, and I miss that. So, and I miss seeing the team and just working with great people. We had a great board. I would say this is one of the best, if not the best board I've been on. Everyone was constructive. There was no jerks. There was no people doing stupid things, which is pretty normal.
Why?
Jason was
Why do you think that's the case? I agree with that. I haven't seen a company. It was a large board. Each investment round had a new lead investor, which meant a new, essentially, board member almost every round.
Well, it comes down to David and the company did an incredible job. When the company's doing an incredible job, it's easy to be happy at board meetings. That definitely helps. The second thing is the temperament of the people on the board were people who didn't regard themselves as a founder. They viewed themselves as an investor and backer supporter of the founders. And I think that's really critical. Everyone who came to board meetings who was an investor seemed positive and wanted to help the company. There was no jerky maneuvers. There wasn't people who were highly fearful, suggesting the world was going to end. And freaking out every board meeting.
Yeah, there's this interesting balance between having the conviction to really back a founder, as you say, but not having the ego where you think, you know, you're the most important person in the room. And David had a lot of options, I think, in terms of financing this company. I think he selected not just on terms, but I think he selected on people who could contribute to the company and wasn't going to mess up that dynamic. And I do think, you know, you were very thoughtful about that.
Yeah, we had a very harmonious board, and you know, I guess I didn't have a huge amount of choice. I probably had about, you know, I guess I had some choice. So I had about 2 choices per round, and I do think we ended up with like the most harmonious, like people on the board. It was a very good board. Yeah, very, very good.
So present day, David. So how's the integration?
Sorry, just one last thing. I'll just plug. Jason mentioned, you know, you asked, you know, what else do you do? And I do think getting great advisors is really important. So I'll plug Orrick. You know, you've been doing a great job for us for the entire time, and you did a great job during the acquisition. You also brought on Richard Smith, from Orrick, who negotiated our definitive merger agreement, and that guy is like phenomenal at doing this stuff. I mean, he's unbelievable. And Steve Malvey on the tax side, and there are other people as well. So, you know, Orrick did a great job for us. We also brought on board Catalyst, which is Frank Quattrone's group, and specifically the partner there who led this deal was Ian McLeod. And he and Catalyst did a great job as well. And I just think, you know, I've been through 2 acquisitions, which is, you know, it's probably like 1 or 2 more than, you know, most people. But, you know, Ian's been through...
$2 billion acquisition.
Well, but you know, so I know a little bit, but Ian's been through like dozens of them, and they just know so much more about this stuff. And I'd really recommend that, you know, an entrepreneur, you only get to sell your company once, so you want to make sure it's handled right. So getting a good deal advisor is pretty helpful too.
So let's turn present day, David. How's the integration of Yammer and Microsoft going? What's worked well, and what lies ahead?
You know, I think it's going. I think it's going extremely well. You know, Microsoft's given us a lot of sort of operational independence. You know, the company's still based here in San Francisco. We're still in our current offices. We're actually moving to a new office that had been in the works for a while. We're still working on our product. We're sort of in parallel with us continuing to iterate on our product. We are looking for integration opportunities with Microsoft, and we're looking for ways to leverage their sales force. They've got something like 40,000 sellers at Microsoft, and I think we've got like 60. So there's a lot of potential leverage there if we can exploit that. So you know, I think it's been a good mix of looking for synergies and opportunities while also being respectful to the Yammer culture and engineering process.
And Jason and George, what lies ahead this year for 2013 investing? What's the next Yammer you guys are going to find and invest in?
If I knew, I wouldn't tell you. But I
had to ask.
I think you know, Yammer was a pretty unique opportunity. We're quite excited at Emergence with kind of the second generation of SaaS and enterprise companies taking advantage of the cloud, taking advantage of mobile, taking advantage of social. I actually do believe, you know, we backed a lot of the horizontal leaders, the guys that went after kind of very broad products that could target pretty much any company, any size company, and in any industry. And what we're quite interested in now is going a little bit more deeper in some of these vertical markets. We have a number of plays in healthcare, a number of plays in the financial services arena. And I think everybody has seen the impact that, you know, companies like Salesforce and Yammer and SuccessFactors and others have had on the broad industry. And now we can kind of go one level deeper in terms of building in domain expertise and best practices from those industries and really creating some really unique companies. We have one company called Viva Systems that does CRM specifically for pharma. You know, and you would think, well, Salesforce already owns CRM, right? So why do you need another CRM company? Well, there's a lot of unique things in the pharma industry that make building a company specifically targeted towards pharma very, very compelling and unique. And this company is on track to be, you know,
I think, a multi-billion-dollar company in a short period of time. So,
George?
Yeah, I continue to look for the non-obvious, controversial companies. When they come into our partnership, people have a very interesting response to them. Some people love them and other people hate them. All the companies that we vote on that people say, yeah, I kind of like that, those kind of go nowhere. So I'm looking for the things that are controversial. My experience, those are the companies that drive big returns. And they're usually driven by incredibly strong personalities as the founders. You know, a mix of obsession and brilliance is necessary, and that's what I look for. But I don't operate off of theses. I just operate off of gut feel reaction to the founders when I first hear the idea.
Good. Well, I think in a little over an hour, we've covered the trajectory pretty well there. I'd like to open it up to the audience for questions. So if people have them, I don't know if Chad or Joyce is here. Do we have a microphone for folks to use? No? While we're doing this, David, I have to ask a question I've always wanted to ask you, just personally, while we get this set up. You know, your background is so varied. You know, you went to law school, you were in Hollywood, PayPal. Did those past experiences help you with your Yammer role and experience, or not? I just wondered, given the variety and the different industries you've been involved with.
Well, I think the PayPal experience, I probably got like a little bit from everything. You know, law school, I probably picked up some legal stuff, and Hollywood, I probably picked up some sales or something. But PayPal was really the key experience, and as we're sitting here talking about it, you know, I was just thinking about how much we really role modeled PayPal's success in building Yammer. So starting with the decision to not be a lean company or a lean startup, to kind of go fat and raise a ton of money. That was very much a PayPal strategy. I think PayPal raised something like $300 million. It was kind of a weird situation because PayPal was able to raise most of its money before the dot-com crash, but the company was largely built after the crash. But you know, we spent, you know, we were just paying people to sign up to use PayPal. We spent like $100 million on sign-up bonuses and crazy stuff like that. So I think this idea of, you know, raising a lot of money, going big, that was definitely the PayPal playbook. You know, the idea of, you know, obviously you want the best CTO co-founder you can find. I mean, Peter did that when he got together with Max to start PayPal, and the way we did the acquisition, how I think, you know, has to be run, has to be fast. The way we organize product, the focus on virality and distribution. A lot of those lessons came from PayPal. So you know, people ask a lot, you know, why is there this PayPal mafia? What was so, you know, why? And I think maybe the reason is just we were able to role model PayPal's success in all these other companies.
Great. So questions we can line up here. Please state your name and then have at it.
Hi there. My name is Jim Donovan. And I work with entrepreneurs in the earlier stages, so 1 to 20 million in revenue as a coach. And I'm wondering, often I work with them in terms of the mindset shifts. So I see their key strategic decisions, and then there are sort of underlying mindset shifts. And I'm wondering if you all could illuminate some of the key mindset shifts for yourselves and the people that you work with that have made you a success in that regard?
So I think there's a few of them. So the first mindset shift was we need to do corporate social networking instead of family social networking. So the original pivot, which occurred back in 2008. I think the next big one was we've got to be in Silicon Valley. So the company was in LA, and because that's where I'd formed Genie, because before that I'd been doing a movie, and I just woke up one morning and I'm like, wait, why are we here? This is kind of a legacy decision. And as soon as we moved the company up to San Francisco, good things started to happen. We were able to recruit, you know, more engineers. We were able to raise more money. We had more industry contacts. We were able to learn a lot more. So I think that was like a critical decision. And then I think probably the third one was the shift in our thinking that, you know, virality is not enough, that it's like really important, but it has to be supplemented with a sales approach. That was really, I think probably those three things were the clearest, like, you know, 180 type decisions.
That's great. Thank you. And do you all have mindset shifts that you see entrepreneurs make that are really key?
Well, I think this idea of thinking big is really fundamental. And people, I think, tend to think that setting low expectations maybe is easier, but it's actually not. It turns out that the bigger the idea, the more exciting the idea, the easier it is to attract great people, financing, partners. You know, people want to gravitate towards that. And so it's non-intuitive, actually. But sometimes setting lower ambitions is actually harder to execute on. And David's earlier point is an important one. Like, the least risky thing he saw was to go big. And I think that's a non-intuitive, it's like the golf swing, I'm sorry, but it's a non-intuitive thing. But once you kind of learn that it works, and you have the talent and capabilities and frankly, the personal conviction to pull that off, that's what I look for now.
I mean, I think that's a really good point. I was talking to an entrepreneur the other day who's looking for something new to do. His last thing wasn't quite working, and he's looking to pivot. And so he kind of pitched me an idea to go after like a $300 to $400 million space, something like that. I'm like, well, why are you going after such a small market? And his answer was, well, I really just want a base hit at this point, And so, I think Jason's point is right on. But also, if companies are bought, not sold, doing something small doesn't actually, it's not like just because you're going after a small market means that you're now going to be able to sell it for a small amount or something like that, or increase the likelihood. I actually think it's the opposite. From an execution standpoint, it's really hard to build a great product that people want to use, and whether you're going after a small market or a big market, that's true. So you might as well actually try and build a product for a big market. That level of difficulty is going to be the same. And then, like Jason's saying, you can actually attract more resources to your cause if the cause is, interesting.
Thanks.
That's great. Thank you all.
Let's go to the next.
Hi, Salim with Select.com. I'm a strong believer in culture. I want to ask you, David, how did you create this culture that had such a high urgency and maintain that sort of a high fever through all the fundraising and beyond?
So with regard to Yammer's culture, we have a very open, transparent, startup-y culture. One of the big advantages is that we are constantly using Yammer. So everything was out in the open on Yammer. So that was very different than obviously any previous company, and it almost intensified the culture. I mean, everyone was dog-fooding the product all day long. That was probably the most significant thing we did. Is we have a saying at Yammer that we are what we build. We're building a product to make companies more open, transparent, agile, and nimble. And so those are the things we value in our own culture.
But did you build a culture around your personality, or just a culture just evolved by itself?
It's not. No, Yammer never really had a cult of personality. If we built it around anyone's personality, it'd probably be more Adam's on the engineering side. And I'm happy to kind of defer to my partner on sort of the EQ type stuff. I don't have very high EQ, so I'm happy to let there's certain managers who are have more empathy and emotional resonance than others, and I kind of let them take the lead on some of this the fuzzy stuff. But I mean, I do value it. It's just
Thank you. Thanks for that. Thanks.
Hi, Andy Huang. So thank you, panel, for sharing all the insights so far. So far, you guys have talked a lot about how David is an exceptional entrepreneur. There are traits about him that are different from anyone else. So one, I wanted to ask you, what are some of these traits that you've seen in very successful startup entrepreneurs? And also on the flip side, what are some of the fatal flaws you see in these people that would turn you away from investing in them?
George, you went to.
I've had the pleasure to invest in a bunch of awesome ones. Elon, David, Jack, Evan Biz of Twitter, Jim Clark, who is co-founder with me at Shutterfly. The majority, I can think of with all cases but one, which I'm not going to identify, the founders are incredibly obsessive, incredibly driven, and will have a need to win and will do anything to win. That's one thing I see, and they have incredibly high intelligence. You know, and there's a clarity that comes out from the best ones like David, where they can specify a vision with focus and clarity down to the product level that I think is key. I mean, look at the obvious. I mean, Apple is still a great company, but Steve Jobs as a founder CEO is more of the model than, not to pick on her, Meg Whitman at HP. The best companies are built by leaders, not by necessarily great managers. So I always look for someone who's got leadership in their personality. It's just, they can't help it. They have to lead.
I concur completely on the level of intelligence and obsessiveness. I would get emails, you know, frankly, you know, at all hours of the night from Lars Dalgaard at SuccessFactors. I mean, he kind of operated, you know, 24/7. Really is the only way to describe it. Just with a level of passion and intensity that raised everybody else's level of passion and intensity around him. And while David may not have, you know, explicitly said this is the culture of Yammer, people, you know, he was the role model, right? His level of intellect and passion around the product was contagious in the organization. So, and the second thing I'd say is people, this is part of this kind of attractor thing, but, you know, you can't do it on your own. So somebody that has that incredible talent is great, but you need somebody who can recruit and enroll other people to come onto the mission, you know? And that's a, I don't know, a charisma or an ability to just recruit, you know, that I find without that, you know, you can be the most brilliant guy in the world, but you need to build a team to execute. You need to build the army. And somebody that can build the army is as important as just the IQ side of it.
Thanks.
I think this, I'm probably not the best person to answer this, but you know, obviously it takes a certain amount of luck to find a market opportunity where you get like some early product market fit. But I think once you kind of have that, I do think you have to be, you know, like these guys are saying, just maniacal about making sure that once you've like found this, that you don't lose it to somebody else. And probably the thing that entrepreneurs have to realize is that, and this, it kind of goes against everything we're taught for the rest of our lives. You know, in school, like everyone gets a trophy just for kind of showing up. And you know, in the startup world, you know, if you win a market, you create $1 billion company. You know, second prize is a set of steak knives. And you know, it's just the reality that in internet markets, we've just seen this over and over again, that the #1 company is worth 10 or 100 times more than the #2 company. It's just not like, this is very counterintuitive, right? The rest of life is not
linear.
It's non-linear. The rest of life is not like that, right? Like in the rest of life, if somebody, you know, is like 10% ahead of you, it's 10%. It's not 100x or whatever else. But in the internet game, like if somebody's like 10% ahead of you and everyone realizes that, then they will attract all the talent, all the financing, and it'll become a fait accompli, and they will win. So you can't let anyone get even slightly like ahead of you or close to you. It's just, that's why you have to be maniacal about this stuff, is that the advantages start to accrete. I was talking to an entrepreneur. I'm actually an angel investor in his company, and he's the #2 player in a space, and it's a great space, and he's got the better product, but the other company, they were like kind of roughly equal about a year or two ago, and he kind of let the other company raise more money and get more attention, and now he's the clear #2, and he can't raise money. So you just can't, that's why you have to be, you know, obsessive about this stuff.
The only counterpoint I would make to this one is having lived through the bubble and seen a lot of companies raise tremendous amounts of money and waste a lot of it, is there is this sense of, you know, you need to be kind of out ahead, but you need to really be executing and fulfilling kind of the promises that you make. So kind of over-promising and under-delivering doesn't work either, right? So it's this kind of weird combination of being able to project a future that gets everybody excited, but to under-promise and over-deliver in terms of what you're actually doing over time. So you're building this trust and reputation and foundation of delivering.
Yeah, I mean, I agree with that. I mean, definitely. Although, you know, this may be an area where the interests of entrepreneurs and VCs may diverge a little bit because, I mean, I kind of believe that VCs should raise as much as they can. Now, it may not be in VC's interest to like overfund an idea that doesn't have enough proof, but you know, just the corollary to all this stuff is that you can win a market just by being the most heavily funded, you know, and you know, now it may turn out not to be a market, like, you know, like Color was a good example where they raised a ton of money and like there wasn't anything there. That was primarily bad for the VCs. I don't think it was great for the entrepreneurs either, but you know, it would have been a failure whether they'd raised 1 million or 40 million. So, I mean, I kind of think it's like on the VCs to make sure that they're investing an appropriate amount. And I think it's kind of up to entrepreneurs to like get as much funding to back their vision as possible.
Actually, so the second part of the question is if the fatal flaw of entrepreneurs that you would not invest in. So is it lacking that maniacal focus, that obsession?
Emotional intelligence, clearly undesirable. Anything else?
Fatal flaw. I mean, integrity is or lack thereof is a fatal flaw. You know, there's a lot of this whole system works on trust fundamentally. So I think you know, building a foundation and a reputation of trust is really critical. I think that you know, again, there's this kind of careful balance between being crazy enough and neurotic enough to believe that you can pull off something like Yammer and not truly being crazy. You know, I mean, and it's not too far actually. You know, I've made the mistake of, you know, betting on the person that was crazy, frankly, or you know, and that's a problem. You know, I had hair before I started in the business, and it's mostly from those that I've lost it. Unfortunately, you don't know for sure, you know, as an investor before you bet on folks. But you know, people do build these reputations over time, and even I've backed entrepreneurs, you know, again that have failed, you know, because they went after it with integrity, they went after it with ambition, and there just wasn't a product market fit, or it didn't work out. And at the same time, you know, there have been some successes, no great successes, by the way, with people with a lack of integrity, but there have been some successes where I wouldn't back them again because I just didn't build that foundation of trust.
Thanks. We'll take George.
Really quickly, like David said it in an interview in a magazine, but I really don't like founders who have hobbies. I don't get hobbies. I don't have any of my own. My hobbies are like flossing and driving to work. I want the founder to be totally in love with what they're doing and passionate and focused on it. I mean, that's what I'm investing behind.
We'll take 2 more questions. Apologies to everybody else. Maybe you can grab these guys after we break, but want to let people go on with their busy day.
Hi, John Spottiswood with Inflection. So we started Inflection in 2007, and one of the books that the whole management team read was The PayPal Wars, which I thought was just phenomenal, sort of personal story in the trenches, and we've tried to adapt lessons, both positive and negative, from that. You've mentioned a few things from the PayPal experience that you brought in terms of virality and the focus on that, as well as picking your CTO wisely. Were there any other either positive or negative learnings from PayPal that you applied at Yammer that you think were critical to the success?
Well, I think the focus on distribution. PayPal, we were one of the first viral products, right, where you could actually email money to someone who didn't have a PayPal account yet, and they could just click the link in the email to pick up their money. That was a really important part of the product because we were trying to figure out how to get a new payment system off the ground, and if everyone had to have an account to transfer money, then you had this huge chicken and egg problem. So we were always focused on distribution at PayPal, and then we kind of figured out that we could bootstrap off of eBay. We kind of figured out that there were a handful of sellers on eBay who were using PayPal, and so we really focused on co-opting their market, and we actually pursued one of the first kind of embed strategies, you know, where we would embed PayPal logos inside of eBay auctions, and this was in the days before Facebook platforms, so companies like eBay thought we were like a parasite, you know. Today, they would try to encourage, I don't know if eBay would, but basically, you know, companies are all trying to create platforms. They all want applications on their platforms. So PayPal, in a way, pursued this like unauthorized app strategy. Anyway, the point is just we innovated not just on the product but on the distribution strategy, and I think you have to do that because you one of the tricky things about distribution is that once you come with a successful strategy, everyone copies it. So we've seen this, right? Like on Facebook platform, the early apps were extremely viral, but then the advantage got arbitraged out as everybody started doing it, and then people stopped clicking on the links. Same thing happened with email virality, address book importing. In the early days, that was a very effective technique. You'd slurp up an address book, blast it with invites. Eventually, people stopped clicking on those invites. They got too many. So, like, whenever somebody comes up with a successful distribution technique, it gets arbed out. The advantage gets arbed out through copying, which means the sort of the upshot of that is that it's usually the case that you have to fundamentally innovate on the distribution model to create a big company. That it's not enough to have a good product, that you've got to figure out something new. So for instance, like with Yammer, what was new about our technique was that it only took one employee in a company to sign up for Yammer to start spreading it. And so we didn't have to, with every previous enterprise product, you'd have to get a meeting with the CIO, convince them to buy it, and then you'd spread inside the company. It took forever. So we actually had this bottom-up grassroots adoption. And now this whole trend is called consumerization. My guess is that if you started a company using Yammer's distribution model today, it would be way less effective because too many people have now done it. And so like employees of a company are probably sick of receiving invites to enterprise services. So you've got to like constantly be figuring out like how are you going to like innovate the distribution model.
Thanks. Last question.
All right, no pressure. All right, hi guys, my name is Tracy Lawrence. I'm building a company called Choose, and I'm just at the early stages. We're in 500 startups, and one of the things that I guess sort of resonated with me is, Jason, when you mentioned going through the board meetings, that there was an evolution from the product to the vision. And so, David, I'm curious if, the vision was evolving, product obviously is evolving. What anchors you? What anchors you to keep moving forward if things do change and they do change so rapidly?
Well, very early on we had this idea for corporate social networking. In fact, we kind of called it that. We wanted to create a corporate social network. That was just based on the fact that as far back as 2007, we thought that social networking was going to take over the world. I didn't know exactly who would win. It looked like Facebook was getting an edge over MySpace, but that whole battle was still yet to play out, but we were pretty confident that everyone would eventually have a social networking account, and therefore people would want to use this new communication medium inside the workplace as well. So we always had that conviction, and that never changed. I can go back and look at the sort of, when I wrote the original spec for the product in late 2007, I wrote the About Us page of the website, where we kind of lay out like who we are and what we do and what our mission is. That could still be used today. That actually has not. It's amazing how little that's changed. What has changed is everything about the product details of a corporate social network, everything about the sales model. We've had total flexibility about how to implement that. We started with a very simple product. It was basically taking, a Twitter-like feed, what are you working on, and munging that with the email verification model of the early Facebook, where you had to have a harvard.edu email address. We kind of took that element, and then we combined it with the ability for companies to claim their networks. And it started off really simple. And once we actually got into companies and saw how people were using it, that changed our thinking of what we needed to be, how corporate social networking would work, how to make it an actual productivity tool. So total flexibility on the product details, the sales model, but not kind of the core of what we were trying to do. And I think if that had changed, then we would have needed to pivot into something else, right? At that point, you're pivoting, right? And the same thing was true of PayPal. The goal with PayPal was always to create this global payment system. We didn't know exactly how we'd do it. We knew email virality was important, but once we saw the eBay opportunity, we're like, okay, put all of our troops on that, not 10%, and that's a really important thing too. When you see something that's working, put all of your resources on it, not a portion. You just put all of your troops into that. You need to think more like the Marines and the Army. The Army kind of, when they fight a war, they gear up and move en masse, and when the Marines just kind of see an opening, they just pour all their troops through it, and so you got to be more like that.
Just one other thing to add in terms of the anchor. The big vision didn't change. The product actually changed a fair amount. And what these guys did, I think, brilliantly was maybe they weren't a lean startup from a financing perspective, but they were a lean startup from a sense of iterating on the product and measuring what was working. And really having clarity on, like, they would get rid of 9 out of 10 things that they would try because 9 of them didn't work. And they would keep the one that was working and then iterate again on 10 more things and see. And that kind of process and iteration and ability to kind of cut to the essence of what users really cared about versus what maybe they thought was going to work, that was an anchor for the company and allowed them to just continue to build success and a better product over time. That I just think, you know, killed the competition, frankly.
I'd say, well, thanks, everyone. I personally want to thank our panelists, George, Jason, and David. I mean, working with Yammer has been the best professional experience in my career. And I think as you saw here today, just actually hearing this conversation, every time I talk to these guys, I get more enlightened and learn more. I hope it was as useful for all of you. So thank you all for spending the morning here. Thank you all for coming, and we want to see you again at the next Orrick Total Access.